Welcome everyone today to our webinar. We will get started here in about 30 seconds as we wait for everyone to join. Okay, welcome everyone to our Ask the Experts webinar today. We appreciate each of you joining. We hope that you and your families are safe and well during this challenging time. We have a large crowd participating on the webcast and some compelling topics to discuss. My name is Bill Maloney. I'm an Executive Managing Director with Riveron. We are excited to meet with you today. As many of you know, Riveron and Conway MacKenzie combined firms back in December of 2019. Conway MacKenzie is a global management consulting and financial advisory firm with expertise in financial and operational improvement and restructurings. The combined firm now offers a full suite of services spanning mergers and acquisitions, financial reporting, performance improvement, technology enablement, and finance operations for both healthy and distressed companies. I'm joined by 4 of my colleagues today who are some of the earliest experts in understanding and navigating the legislation that Congress passed this past week, the legislation known as the CARES Act. Steve Weibo is a Senior Managing Director and leads our Detroit market. Steve has more than 20 years of financial advisory experience working with distressed and underperforming companies. He has deep expertise in the automotive industry, as well as in the consumer products and real estate brokerage industries. Andy Dillon is an executive director in our Detroit office and leads our government and municipal advisory practice. Andy has more than 30 years of experience and is currently monitoring government policy initiatives affecting the U.S. automotive industry. Gary Bedsole is a managing director in our Atlanta office. He's an expert in M&A tax with over 20 years of experience working with companies, both public and private, domestic and international, across a variety of industries. And Ann Heffington is a managing director in our Dallas office. She has over 30 years of experience focusing on global tax accounting, establishing tax-efficient structures, leading integration of acquired companies, and implementing transfer pricing. These 4 individuals have all been intently focused on the CARES Act, which provides approximately $2 trillion in economic relief as a response to the COVID-19 pandemic, including direct financial assistance to Americans, aid to small businesses and employees, and other provisions to help stabilize our economy. So our goal today really isn't to make you an expert necessarily on the legislation itself, but rather pull back the curtain for you on some of the more relevant provisions and ways that you and your business can maximize some of the liquidity that the provisions offer. Before we jump into the content today, just a few key reminders. On our website, riveron.com, you can access all of our previous Ask the Experts webinars. A number of great accounting and reporting topics are covered there. And perhaps more importantly, mark your calendars for next Thursday, April 9th. We'll be hosting our next Ask the Experts webinar. We'll be focusing on how to strengthen your supply chain in the current climate. And we plan to host a number of these webinars during April on a variety of relevant topics. During the webinar, we will include 4 polling questions, which must be answered to be eligible for CPE. Please make sure that your pop-ups are enabled. Sometimes those pop-ups come in behind the window that you're on, and so just realize that you need to have the pop-ups enabled and ready to go for those questions to work. Also, we welcome your questions as you listen and participate in the webcast today. There is a Q&A option in Zoom that you can use. Please feel free to do that. We'll try to get to the questions, but if we don't, we'll respond separately. We've already received some of those questions, and we'll try to work those in to the session today. The webinar evaluation form and CPE certificate will be emailed to you within a couple of weeks following the webinar, along with access to the deck today and our contact information. Please do note that while the on-demand video will be available on our website, the on-demand is not eligible for CPE. And with that, we'll start right in actually with our very first polling question, which is as follows. What is your estimate of how long your current cash on hand can last? A, less than 2 weeks. B, 2 weeks to 1 month. C, 1 to 3 months. And D is greater than 3 months. So again, take a minute here to respond to that question. We'll give you a little bit of time, but while we wait, we'll have Andy Dillon will get us kicked off with an overview and walkthrough of the Act. Andy?
Great, thank you, Bill. Do we need to wait for the question polling to answer or for the next slide?
Should be good to go, Andy.
Okay, great. Thanks, Bill. Well, first of all, good afternoon, everyone, and thanks for joining the webcast here today. I also want to start by wishing you all health and safety, as well as your families and coworkers. We're happy to go through the CARES Act, but obviously the health considerations affecting the country should be our #1 priority. As Bill mentioned, Congress acted and passed a stimulus program to help us navigate the crisis on an economic front. And they did this in large part through a large act, the $2 trillion CARES Act that was just enacted. And there's 4 basic programs that we'll talk about today. I'll cover 3, and then our tax professionals will cover the 4th one. We'll go through the first 3, then Steve Weibel will talk about issues relating to the polling question we just took, which is about your liquidity and how to manage through it. But here I'll focus on the 3 primary loan type programs available to businesses, and hopefully some of them apply and can be helpful to your businesses. So if that, we can move to the next slide, and we'll start with the very first program, which is the Paycheck Protection Program. This is a $350 billion program for small businesses. And the money can be used for payroll, rent, mortgage interest, utilities through 6/30, and the portion that you use for that can be forgiven. So if you're eligible, you definitely should apply because the money does not have to be repaid. The cost of the money is fairly low cost, and it's a deferred repayment for the portion that is not forgiven. It's unsecured, and it's going to be junior to senior debt. The maximum you can borrow on this is $10 million, or 2.5 times your average monthly payroll for the last 12 months. In order to be eligible, you have to maintain at least 75% of your payroll base from the prior year. And if you've already done furloughs or layoffs to go below that number, they give you a window of time to rehire people to meet that threshold. Next slide, please. This program will be administered through the banks, and U.S. Treasury issued their guidelines on this program this week. And now it will move to the SBA for their regulations. The program will be administered through the banks. So it's going to take them some time to prepare what they will require of you to apply, but keep an eye on this program and the rules that come to follow. Next slide. We'll speak about eligibility requirements. As I mentioned before, it's a small business program, and generally speaking, that means less than 500 employees with a revenue threshold. But it varies by industry. So what we do is we suggest you check the SBA website to see what your particular industry's employment numbers and revenue maximum numbers are. I was on the phone this morning with one of our clients who does over 100 million in revenue, has over 1,000 employees, and they're eligible based on the SBA standards. So it's important to know where your business fits into the SBA standards. And in the CARES Act, they made a specific exemptions for hospitality and food services to say that the rules apply by location, which will greatly broaden those who are going to be eligible. The business has to have been in existence before February 15th of 2020 to be eligible. Next slide. I've kind of lost my screen here, but yeah, so can we go to the next slide?
Everybody, we're just experiencing a technical difficulty with Zoom, and if you could just give me 1 second while we get this out. Andy, can you please confirm if you see the slides up?
I'm sorry?
The slide should be back up. Are you not seeing it?
I don't see it, but I can move forward without it.
Okay, with the content, and I'll continue to work on the Zoom in the meantime. Apologies for this, everybody.
Well, on slide 10, do you want me just to proceed?
Yes, please.
Okay, yeah. So slide 10, we talk about affiliation, and basically that means, and I've got it now, that under common ownership, you still have to meet the rules even if you have multiple locations. There's an exception to that in the CARES Act, which is hospitality and food service, and organizations that are funded through SBIC. As of today, we would think that if a private equity fund owns 2 different businesses that in the aggregate exceed the minimum employment and revenue numbers, that they're not eligible. Although there is some talk in Washington and among Wall Street that Treasury and the SBA may loosen those restrictions. So if you are owned by a PE fund with multiple portfolio companies, I would assume that you're not going to be eligible, but you're going to have to follow the course of events as the SBA issues guidelines going forward. Next slide. As I mentioned, this program is going to be administered through the banks, and most of the banks don't have their guidelines out yet. And unfortunately, I think a lot of them are going to wait until the SBA issues their guidelines, which today is scheduled to be on April 11th. So it may be a couple of weeks before you have clear indication of what you need to do to apply for these. But in the meantime, I would check out the SBA site, understand your industry, and know what the guidelines are for you as it relates to employment and revenue numbers. Okay, we can move to the next slide now. The CARES Act also provided some assistance to an existing loan program that was out there, which was the economic injury disaster loans. These are capped at $2 million. And what they've done is they created a pot of $10 billion. And what's interesting is if you have an application in, you can go to the bank where you have that application and you can ask for a $10,000 grant. And according to the legislation, that grant is forgivable and it should be provided to you within 3 days. Again, the SBA rules apply for this program. Maximum is $2 million and you can't double dip. So if you're using these proceeds to cover payroll and rent and utilities, then the payroll protection program, you can't double dip and use the same money for one purpose. So you can use the money for different purposes and have both loans out there, but you can't use the same money for the same purpose. Next slide, please. Then the third loan program that's going to be out there is $500 billion that they've set aside for mid-sized businesses. And this is for businesses with 500 to 10,000 employees. Interestingly, they say the interest rate is 2%. And again, this will be administered by the banks. The rules for this program are not established, but there has been some movement on 46 billion of this is carved out for airline, air cargo, and transportation national security businesses. And Treasury did issue guidelines for that program this week. Because this will be administered by the banks, you're going to have to work with the local banks on the application process for tapping into this 500 billion. And the money's available to, as I said, these mid-sized businesses, but also state and local governments can apply as well. There are some strings to this money, which is you have to retain 90% of your workforce. You have to commit to do that. You can't be in bankruptcy. You have to be domiciled in the United States. You have to agree to no outsourcing. You can't seek to modify any collectively bargained labor agreements. And if your company is, if there's an effort to organize the workforce at your company, you have to remain neutral. And then there's rules about no dividends during the outstanding loan, no stock buybacks up to 1 year after the loan is repaid, and there are compensation rules that apply as well. And also that 2% I think is misleading. This is modeled after a program for investment grade debt, which was used to maintain liquidity in the economy. There are provisions in this law that say that the US Treasurer has to protect the taxpayers. So there's discussions about, that interest rate, but also having to provide warrants or options or some equity vehicles for a higher rate of return that reflects the risk. Because this program is modeled after an investment grade strategy, I think you're going to see a lot of movement in the rules to it. And again, this is where private equity today is not likely eligible, but I think you're going to see those rules loosened, because if the program is only eligible for investment grade credit, it's not going to accomplish the purpose that Congress intended, which is to stimulate the economy and help businesses navigate through this difficult time. If we could move to the next slide. And I think then actually the one past this one. Yeah, next slide, please. Yeah, there we go. So we've covered the three major programs: the Payroll Protection Act, the EIDL, and then this mid-sized business support program. As I mentioned, there's specific carve out for airlines, air cargo, and national security. The CARES Act also provides funding for individuals, state and local governments as well. So with that, that wraps up the three major loan programs available through the program. And if we can move to the next slide, I'm tasked with putting out the second polling question, which is, which of these legislative programs might you access? The PPP program, the EIDL loan program, or the mid-sized business program? Thank you.
Okay, thanks, Andy. This is Steve Weibel speaking, and given the technical difficulties there for a few minutes, I will try to speed up my piece. I only have 6 slides. I want to start with the polling question, the first one, and that was how many people on this call have liquidity in less than a couple weeks to over 3 months, and kind of bucketed in 2 summaries. 56% of you said less than 3 months. And then of course, 44% said greater than 3. So for those of you that, over half of you that said less than 3 months, I think you need to pay attention to this section, because I'm going to give you some tips on some things that you should be doing to conserve cash and manage liquidity. So Andy addressed the aid, and I'm going to address the sort of what I'll call tactical and practical things you should be doing right now. So on slide 18, you'll see I bucket this sort of in 3 things, or 3 categories. The first 2 you really should have already done, so I'll touch on those very briefly. And that is, worrying about the health of your people and your business, and then ramping or shutting down the operations to the extent you're in a state where you're considered non-essential service, which by now most states have a non-essential service list. 3 and 4, deploying short-term liquidity measures and funding. I'll talk mainly about 3. Andy covered 4 already. And then 5 and 6, I would say, are, not too early to be thinking about an efficient restart of your business, how to get your people back, how to get your operations back on board. And then number 6 is, we all long for this day, and that is, we'll emerge stronger as an economy and as a people. And it's not too late to be thinking about strategic opportunities, specifically, M&A, opportunistic M&A. So with that, I'll go quickly to the next slide. Next slide, please. Okay. So again, number 1 was a healthier people, and that's stating the obvious. And again, I hope everyone's families are safe and everybody's healthy. But some states do have exceptions for critical services. And I think, as Bill said at the beginning, I run our automotive practice, and I have lots of automotive supplier clients. And in many states, there is a carve out for transportation related businesses. And I am running a couple of automotive suppliers as a chief restructuring officer now, and we've had to make some very difficult decisions regarding leaving our people at work. And, that would include social distancing and, heavy cleaning and things that, of course, will attempt to keep our people safe. But we've had an instance in one of my plants that I'm running of a gentleman that came down with the virus. We decided immediately, once we found that out, to shut the business down entirely around the world. We have operations in Windsor, Ontario, Canada, Mexico, and in Europe. So, of course, thinking of your people really needs to be first and foremost before anything else. So ramping down, on this page, you'll see, how much of the operations are you able to ramp down, or should you ramp down? And I won't go through each one of these boxes. I think this presentation will be made available later, so feel free to, look at the various things on the checklist I'm about to go through and give me a call if you have questions. But I want to cover just a couple things. You need to be thinking about your product planning people, and do you have the ability to schedule remotely? In many instances, if you're a tier 2 to a tier 1 customer, or you're a B2B type company, you need to be thinking about, when we do come back up, do you have to have supply at your facilities, or finished goods at your facilities, or people in a case of a service business available in advance of when your customer comes back on board, in the instance of a B2B? The answer is probably yes. And if your customer's broadcasting that they're coming up, in 2 or 3 weeks from now, you probably need to consider getting your people back a week or so early, just to make sure that you've got the requisite level of material, finished goods material, available to ship, or people ready to go to service your customers. I would say that things are changing very quickly. And again, in a more industrial automotive application or environment, we're seeing the customers making decisions by the hour in some instances. And for those of you that follow the auto industry, Ford announced a couple of weeks ago that they were going to come back up this week, the end of this week in Mexico, and the week after in many U.S. cities. And then they reversed that 2 days ago and said, we're going to be closed indefinitely. So the broadcast for releases for some of our supplier clients, we're changing by the day. Get ready to build, no, don't build. Send some inventory, don't send inventory. So you need to make sure that you're monitoring what your customers' demands are, and be flexible to be able to react to that quickly. Some of the hibernation things and safety of your plants, and to the extent you have toxic materials, if you're a plating company, or you have oil that needs to be managed for your presses, or whatever the case may be, clearly mothballing and making sure that you have the requisite level of security and the plants are safe, so that you don't have any problems before you come and ramp the company back up, obviously, is critical. Again, there's a lot on here, so I'll just keep going, and feel free to reach out to me. Next. So on page 20, next slide, please. Looks like potentially we're having, oh, there we go. So the next section is about cash and what we call the cash office. And I have 2 slides on this, and the next slide is a checklist. But I guess from a liquidity management standpoint, what's critical here, of course, is managing your incoming deposits. Many companies nowadays are on ACH or direct deposit or wires, electronic payments, etc. So, having someone physically there opening checks may not be the case, but maybe some smaller businesses, your customers do still pay you with checks. And, are you getting the mail? Simple things. Are you having someone run to the bank to cash the checks? We've seen lots of instances of our clients, they're actually becoming cash rich because they're getting cash in from their customers to the extent their customers are able to pay them, but they're not paying rents or people costs because their people are on layoff or furlough. They're not paying their suppliers. So we're actually seeing a big build of cash at the moment, which I think has allowed some companies to not have to, call us for our crisis management services or, thinking about filing for bankruptcy or worried about insolvency because, again, they're building cash. But the minute they come back to work and start needing the requisite supply to fulfill customer orders and getting their people paid and the rents and the utilities caught up to speed, that cash is going to get depleted very quickly. So, treasury management and what we call the cash office is absolutely critical. It's not always an option to not pay your payables. And in many instances, you may have, some lower level suppliers or some mom and pops that you rely on for widgets to make a product for your customers. And, it's not safe to assume that everybody can manage, even if you are able to manage with your incoming cash. It's not safe to assume that the supply base below you necessarily can. So I think strong communication with your suppliers and making sure that when you do come back online, that they're going to be able to ship you product or provide services that you rely on to service your customers. You should be in strong communication, frequent communication, especially with the suppliers that you may have thought of, were smaller or perhaps a little bit weaker in terms of their ability to manage working capital. Another thing here is approaching your lender. I think that, what I would emphasize here is communication. And, lots of my clients are borrowing up on their revolvers. Many of them are even borrowing with, from advice from us beyond what potentially a financial covenant would allow them to. So to the extent you have availability on a borrowing base, but it may otherwise cause, say, a debt for EBITDA violation next quarter, you may not be too worried about those violations at the moment. And, we always say cash is king in these types of situations. And, worrying about covenants and things may be secondary to actually getting liquidity in the door. So if you have access to a revolver or you have an asset-based facility that has room, you may want to strongly consider borrowing up on that. Obviously, communication with your bank is key, and it's not good for a banker to come into work or get online the next day and see your account fully drawn without some communication. So encourage you strongly to be talking to your lender before you take any drastic actions. Another thing you may want to consider is what I call trapped capital. Do you have borrowing base availability because you have ineligible receivables that you haven't collected and potentially could in this situation? Do you have foreign accounts that are from, investment grade, blue chip OEMs or blue chip customers that really probably should have been made available anyway, but weren't? And there are things you can do in terms of negotiating with customers or getting comfort letters that, a customer in the U.S. would guarantee or backstop a payable for a foreign customer, for example. Is your inventory advance rate, unreasonably low, and is your inventory otherwise saleable? And should you be talking to your lender about freeing up that type of trapped capital? So lots of things to do on a working capital management side. And again, some of this stuff is listed here, but feel free to reach out to me with questions or ideas. This is kind of a checklist of what you should be doing with your people, your working capital, your OPEX, and some other levers. Again, I think I've addressed a few of these here. One I did not touch on, though, was Catbacks deferrals. Many businesses were growing before 4 or 6 weeks ago, and you may have invested capital for new launches of new product. And you may have some tied up capital in your factories or in your people, for example, in your systems. And, should you be spending money today, precious capital, which is otherwise, maybe available to pay people or keep the lights on projects for the future? And, when you're in a crisis, you worry about today first and tomorrow second. And many of your customers that were otherwise going to launch new products potentially may be delaying those launches. And therefore, what you thought was going to be a launch of a new product 6 months from now may actually be launched a year from now. And spending that capital, which you may otherwise spend today in normal course, may not be prudent to do. The other thing under sort of a make versus buy scenario, if you had functional capacity available before, you probably have a lot more of it now. And it's probably safe to assume that most industries that we service and deal with are going to be soft for a period of time. And if you were currently buying from someone that you otherwise could have made but for available functional capacity, insourcing may be a great idea at this point. So looking at your capital that you have deployed and you have functional and bringing in supplies that you can otherwise make may be prudent, just given what is likely to be a softness in demand for various products that you make. Next slide. Okay, so here's the good stuff. We're going to come back on board, and most of you on this call run businesses or senior managers in businesses that will recover and be just fine. And despite the fact that about half of you said you lack cash long term, there are ways to mitigate that. As Andy said, there's lots of government aid available, and I'm very confident that we're all going to be okay. So you need to be thinking about when the operations do come back, not if, but when. What kind of ramp-up curves should you have? What kind of scheduling of your people and your raw materials should you be thinking about? I stated earlier that your customers may expect you to be ready to go on day one, which may require you to get back a week or two before and start building some of the requisite inventory that you have releases or demands for from your customers. So be thinking about, the end is near, hopefully in this quarantine, and we all will be back to work, physically going to work in short order. In some states, it's probably a few weeks away, but you need to be thinking about when you go to work on whatever Monday that is, do you have the proper scheduling of people and materials and services available to restart your business? And then lastly, on the momentum boost here, there will be some companies that are really good companies that otherwise had fairly weak balance sheets going into this cycle. And I believe that now is the time, if you're fairly well capitalized, if you're owned by a sponsor, if you're a public company with access to cash, or you have liquidity from your existing senior lenders, it's not too early to be thinking about M&A. And there will be some companies that need some rescue capital that are otherwise very good companies that produce in adjacent businesses or perhaps are your competitors. And I believe that there's going to be a fairly good consolidation in several industries of what I think are very good companies that lacked an adequate balance sheet to survive here. So it's not too late to be thinking about that. Folks at Riveron and Conway MacKenzie can help you through that. We can help you with M&A, due diligence services, etc. So by all means, reach out, but it's not too early to be thinking about growing your business back. With that, Bill, I think I will hand it off to the next presenter.
Yep, no, great. Thanks very much, Steve and Andy. Really appreciate that. We'll move right into the cash tax side here with Gary and Ann. Gary, go ahead.
Thank you, Bill. So in addition to the programs discussed by Steve and Andy, the CARES Act made some important changes to the tax code. Ann and I are going to address those. I'm going to cover some opportunities for cash tax refunds. Ann's going to address some cash tax type deferral programs. The changes to the tax code were scored at about $600 billion. So a significant part of the overall $2 trillion plus package in the CARES Act. So the very first change here that I'm going to discuss is the change to net operating losses. So historically, whenever a corporation reported negative taxable income for a year, that's an NOL or a net operating loss, the corporation could carry that loss back up to 2 years and apply the loss to taxable income in those earlier years and receive an immediate tax refund. If there are any of the NOL remaining after the carryback, the loss has been carried forward for up to 20 years, 20 years before it expired. That was the historical rule. At the end of 2017, the Tax Cuts and Jobs Act passed, and the rules changed for NOLs from 2018 going forward. So any NOL arising in 2018 going forward, there was no longer an opportunity to carry it back and get an immediate cash tax refund. There was a carry forward only. The 20-year limitation on the carry forward fell away. So there's indefinite carry forward going forward. However, you could only apply the NOL to up to 80% of your taxable income. So that's where things stood after the Tax Cuts Jobs Act at the end of 2017. So the CARES Act came in and created a third bucket of NOLs. So for any NOLs arising in 2018, 19, or 20, you now have this 5-year carryback, this new carryback. So that's designed to permit taxpayers, corporations to immediately carry back NOLs for up to 5 years and get a refund. There's no longer that 80% taxable income limitation for the years 18, 19, and 20. And then once the NOLs pass 2020, the 80% limitation kicks in. You can show the next slide, it'll show the 3 buckets of NOL carry forwards. And there they are laid out. The important point here is if you generate an NOL in 18, 19, or 20, you carry it back. The current tax rate is 21%, but you're carrying it back to years where the statutory rate was 35%. So it produces a bonus bang for the buck, so to speak, with a higher tax rate in the earlier years, a bigger tax refund.
Hey, so Gary, quick question here, really then. So clearly a pretty significant or potentially significant cash tax benefit in play here. What, specifically, what steps should a taxpayer take to obtain a refund here?
Yeah, so that's a good point. That's the practical point. How can we get a refund the quickest? So first point is you cannot carry an NOL back until you filed a return for the year. So everyone, if you're a calendar year taxpayer corporation, you should have filed a return for 18. Perhaps you reported an NOL in that return. So the door's open for 18. 19, perhaps you haven't filed a return for 19 yet. 20 obviously hasn't gotten here, so you haven't filed a return for 20. So there are generally 2 methods, and the IRS is going to issue further guidance on this point. It needs to be addressed, but there are 2 methods. One is called an application for a tentative refund. It's Form 1139. We call it a quickie refund. So essentially, the IRS has to issue a refund after it looks at the application in about 90 days. The problem is, historically, the IRS has put a 12-month time limit on those. So, for example, the 18 tax year, you have 12 months following the close of the tax year to file that related to that 18 tax year. So we're arguably too late for 18 to use that form, the quickie refund form. But again, the IRS is going to issue guidance, so hopefully there will be some relief there to permit that quickie refund for that. Other than that, you have to file an amended return for the earlier years to claim the refund. That's going to take longer than 90 days, presumably. But again, we're waiting for some guidance from the IRS on that. Other points to consider around the NOL carrybacks, if you're carrying it back into, let's say the corporation was purchased sometime in 18, 19, and you're carrying it back into earlier years, you're going to need to look at your contracts. Hopefully they cover who has the right to refunds from that. If there's going to be any cancellation of debt income, you need to really think hard about carrying it back. COD income could result in some attribute reduction. That occurs on the first day of the next tax year, so you obviously want to carry it back to get a benefit before the NOLs are reduced. So that's a summary of the NOLs. I'm going to move next to AMT credits, which are very similar. So prior to the Tax Cuts Jobs Act, taxpayers, corporations were subject to something called the alternative minimum tax, or AMT. Individuals are also subject to it. It's essentially an alternative tax system to the regular taxable income computation where you add back certain preferences. If you're subject to that, corporations are permitted a credit carry forward that they apply whenever they fall out of the AMT system in subsequent years and fall back into the regular system. They get a credit. So essentially the AMT is it's kind of like a prepayment of later years of taxes. The Tax Cuts Jobs Act limited the amount of credits you could take going forward following 2017 to 50% of what otherwise would be permitted. The CARES Act takes away that 50% limitation for 2019. There's also election. You can take it away for 18 as well. So there's an immediate possible relief if you were an AMT taxpayer before 2017 and you brought those credits carried forward into 18. So just pointing that out there. Next slide. So those are two immediate potential cash tax refunds. There were some changes to the computation of taxable income that could result in some NOL potential carrybacks, some reduced cash tax outflows going forward. The first was the change to the interest expense limitation. That's called the 163J limitation. Essentially, the Tax Cuts Jobs Act imposed a limitation on the amount of interest expense that you could deduct. It was limited to about 30% of, it's called adjusted taxable income, but essentially it's EBITDA. The CARES Act increased that limitation to 50%, so there's more flexibility to deduct interest. There also was a change to bonus depreciation for qualified improvement property. Those are improvements made to non-residential real estate after the real estate was placed into service. There was what most people think was a technical flaw in the Tax Cuts Jobs Act where that qualified improvement property was not subject to bonus depreciation or immediate expensing. The CARES Act made it eligible, and it's retroactive all the way back to 2018. So perhaps taxpayers can go back to 18, file amended returns. Maybe there's changes of accounting methods that are required as well. But there's some opportunity to get refunds of earlier years, 2018 taxes. And then finally, the Tax Cuts Jobs Act imposed a limitation on the amount of business losses that could be deducted, and the CARES Act repealed that limitation through 2020. So I think with that, we're ready for our polling question on the first tax section. So which cash tax refund opportunity would be most beneficial to your company? The NOL carryback, the AMT credit, the 163J laxing, or bonus depreciation, or none of the above? Give it a few seconds. Okay, and while those are finished up, I think I'm going to turn it over to Ann.
Sorry for interrupting. Just a quick announcement for the attendees. If there are any concerns with the Q&A, with the polling questions, please just reach out to us on the Q&A.
Thank you. And in the interest of time, I'm going to turn it over to you now to cover your section.
All right. So one of the pieces of the CARES Act was an employee retention credit, obviously trying to keep some of America employed. The employee retention credit is a refundable credit against employment taxes for eligible employers. Eligible employers are those whose businesses have a full or partial cessation of business due to COVID-19, or have significant reduction of year-over-year quarterly receipts of 50%. The credit is equal to 50% of the wages, which includes healthcare benefits, paid to employees from March 13th through December 31st of 2020. Now, depending on the number of employees, the pool of wages which the credit applies to differs. So the first pool is employers with 100 employees or less. This credit applies to qualified wages up to $10,000 per employee. So with the 50% credit, it's a $5,000 credit per employee. The other bucket is for employers with greater than 100 employees. The credit is still on qualified wages up to $10,000 per employee, but it's only on those employees unable to work due to COVID-19. All right, another opportunity for a cash tax refund comes out of Really, there was earlier legislation related to COVID-19, the Emergency Paid Sick Leave Act. So this required employers to pay sick leave to employees missing work either because they are suffering symptoms of COVID-19 or they're providing care for a child or a quarantined individual. This only applies to employers with fewer than 500 employees. It's effective from April 1st through December 31st of 2020. Now, the CARES Act comes in behind the Emergency Paid Sick Leave Act and limits the amount of pay required to be paid to these employees missing work. The first tranche, those employees that are suffering from COVID-19 can be paid $511 per day for 2 weeks, so an aggregate of $5,110. Or for those providing care for children or quarantined individuals, the amount is $200 per day for 2 weeks, so an aggregate of $2,000 for those employees. The employers who pay this qualified leave wages retain the amount of their federal employment taxes equal to the qualified leave wages paid. So if their 941 taxes are less than the amount that they paid out in these qualified leave wages, there is a credit that could be issued back to the employees. There is, at the time of preparing the slides, the form had not been issued by the IRS, but it appears that Form 7200 was issued yesterday. The title of the form is Advance Payment of Employer Credits Due to COVID-19. So if you qualify, if you are under 500 employees and are paying sick pay, you might look into that Form 7200.
And just a question for you here, because we've seen some different questions come across as it relates to the 500 employee threshold. What you spoke to there obviously is for fewer than 500 employees. What about circumstances when an employer is part of a larger group, more than 500?
So that definition is goes to code section, which I hate throwing out code sections on webinars, so excuse me, but it's 52A and 52B, but it's basically members of the same controlled group with more than 50% control. So it is, you know, a lot of our PE clients are going to be over that when you get into a same controlled group with the 50% common control. All right. Delayed cash payments. Do we want to talk about the results on this polling question? It looks like the NOL carryback of those that will take advantage would be the most likely. So if you have any questions on how to do that, Gary discussed some of those, please reach out. All right, delaying cash payments. IRS Notice 2020-18 was issued allowing postponement of federal income tax payments that were originally due on April 15th to July 15th of 2020. This notice also delays filing a specific federal income tax returns. There's no extension required to be filed for this delayed payment. There's no dollar amount limit on the payment that is being made. This applies to persons, which means broadly individuals, trusts, estates, C Corps, S Corps, and partnerships. And it's not a result of COVID-19 that your payment is delayed. You don't have to prove that you were sick or there's any impact due to COVID-19. The period from April 15th to July 15th will be free from any late payment penalties or interest. Okay.
And can I just ask you, and maybe just a question that's come across on this one as it relates to the delay in the federal tax payments. Does that also then apply to the estimated payments due between April and July?
Great question, Bill. So estimated payments that are due in between April 15th and July 15th are not covered. This only relates to payments that were due on April 15th. Now, the other thing that's interesting to note is if you already have one scheduled to be paid, it's up to you to, I mean, it's not, the IRS isn't going to give your money back if you pay it early, and this doesn't impact refunds. Okay, the last one, there's a payroll tax deferral, which is a great option. This came in under the CARES Act, which allows employers to defer payment of their share of Social Security tax. So the 6.2% paid on wages in 2020. This deferral applies to payments made to employees after the date of enactment, March 27, 2020. So if you make a payment after March 27th, but it was for a pay period ended, say, March 15th, this deferral still applies. It's for payments after the date of enactment. 50% of the deferred payroll taxes will be due December 31st, 2021, and the remaining 50% are due December 31st, 2022. All right, I think we have another polling question. Yes. So which
Very
tax
good,
payment?
thanks.
Yes, Bill, you go ahead.
Sure, thanks, Ann, very much. Which tax, this is polling question 4. It says, which tax payment, reduction or delay opportunity would be most beneficial to your company? A, delay of federal tax payments related to 2019. B, delay of federal estimated tax payments related to 2020. C, payroll tax deferral. And D, none of the above. We'll let take some time here to answer those questions, to answer that question, respond, and we'll talk about it in here in a second. But quick comment as we get close to the end here, and we're going to answer some Q&A. I think we'll have a couple minutes to do that, but we appreciate you taking time to join us. I know here at Riveron, we're experiencing many of the same challenges, both at work and at home, that you and your teams are facing, and we really look forward to continuing to partner with all of you, stand ready to help with whatever business challenges that you are working through, whether they relate to the CARES Act or other areas of your business. So looks like on this polling question, Ann, it's a pretty even layout there. Any reaction to what you're seeing on the screen, Ann?
Yeah, it's very interesting. My guess would have been the payroll tax deferral, since that pretty much applies to everybody, even if you have a net operating loss like the area Gary covered. But it is interesting results.
Good. Well, we've had a couple of questions that have come across, actually had quite a number of them. Like I mentioned at the beginning, we won't get to all of them, but do want to answer a couple of them here briefly. And the ones that we don't get to, we'll certainly reach out to you and make sure that we can get those questions answered for you. But Andy, first one is probably one that's more directed to what you were speaking about earlier in the presentation, the different programs that you're going through. Could you just speak to which of the programs that you spoke about are exclusive and preclude participation in others? In other words, can a business apply for the Paycheck Protection Program and an emergency disaster loan? How does that work?
Yeah, you can apply for both, but the use of the money cannot be for the same purpose. So you can't apply for a EIDL plus a PPP and then use it for payroll. So if it's for different purposes, then it's fine to pursue both.
Got it. Very good. And Andy, also, another question that came across, what type of format does the support need to be in? So just in terms of the evidence, for submission to the banks, whether companies need to file the W-2s or 940s or provide a single Excel file with the breakdown of expenses. What does that all need to look like in terms of making this happen?
Yeah, so the program will be administered by the local SBA lenders. So that's good and bad. It's good because you don't have to go get approval from the SBA, but it's has a negative in that we have to wait for the banks to, develop their protocols for the application process, which may not be until after April 11th. But I wouldn't wait to reach out to my local SBA bank. We're hearing from those that don't have pre-approval authority that they're referring all the new applications to the approved SBA lenders in their communities. And if you're not one of their customers already, you're not going to be at the front of the line. The pre-qualified SBA lenders are going to handle their clients first, and then the referrals from other banks will be processed after. And the whole PPP program is a first come, first served program. So there's $349 billion available, for that program. And as I said at the beginning, these are forgivable loans if the monies are used for payroll, for rent, for interest on mortgages, for utilities. So they should be high on everyone's list if they're eligible. But it is first come, first serve. So I'd start the dialogue with your local SBA lender today and get a sense for what they're going to require. The program also doesn't require ability to repay as a condition, but that doesn't mean you shouldn't anticipate you're going to have to provide financial information and backup material.
Got it. Very good, Andy. One final question here that we'll get to. This one maybe is best directed at Gary. Gary, can taxpayers file a preliminary or temporary return for 2019 and get a refund quicker that way?
They can, and the key is you have to file that tax return before you can carry back your NOLs. Some taxpayers are looking at ways to trigger short years for 2020 as well. So there may be an opportunity there as well. But the key is you need to file the return that has the NOL in it before you can begin the carryback process and obtain that refund. So yes.
Super. Thanks very much.
Can I just jump in and add to that?
Please,
Gary's point? It doesn't have to be everything is 100%. Because obviously we're still dealing with getting financial information. So it's kind of a tentative or a preliminary return. And Gary, you may have made that distinction, but I just wanted to make sure our participants knew. Coming from industry relatively recently, you're not going to have your perfect return ready by April 15th, April 30th, but get a tentative return ready, file it, and then you can replace it before the deadline with your perfect return.
That's great. Thanks for that additional color. And in closing, let me just highlight for you on our final slide here some of the thought leadership on the topics we discussed today. You'll find all of these on our website. We have a number of thought leadership pieces that are relevant to COVID-19, including our new comprehensive guide, which is called Preparing for the Now, the Next, and the New Normal. The first part in that series, The Now, a guide to dealing with disruption, was released last week, with the next part in the series scheduled to be released here in the next week or two. We're looking forward to that. We really appreciate everyone joining for your time today. Once again, our next webinar is a week from today, April 9th, and we look forward to meeting with you again then. In the meantime, be safe and enjoy the rest of your day.